Well, good morning, everyone. It's 9 o'clock on the dot, so we're going to get started. I know we've probably still got some attendees coming on. Just to go over a couple of housekeeping things right away. If you could please mute your computer so that we don't have any background noise. I think everybody should come in unmuted. And if you have questions as we're going through the presentation here, I'll ask that you use the question box over on the GoToWebinar screen. We're going to try to get to those as we make our way through the presentation and through the topics. And we have saved some time here at the end to go through a few additional questions at the end. If we can't get to any of your questions today, we'll be sure to follow up with you after the presentation. And if you run into any technical issues, you can email Corey. Her email address should be on the initial email that you got with your registration. So you can shoot her an email, or we'll try to monitor the question in the chat box over here too. But again, please try to use that question box if you've got questions for us as we're going through our presentation. So we've got a great group of people here to present to you today. We're going to go through some nonprofit financial management fundamentals. And Brianna, if you want to move the next slide. So just to give you a little bit of introduction on Hawkins-Ash CPAs, we do have 10 offices through the states of Wisconsin and Minnesota. We have 24 partners. Our net revenue is $29 million. There are 63 plus CPAs, growing every day as we have people taking that exam. Founded in 1956. Overall, we have over 180 employees and over 10,000 clients. We serve all types of different clientele, nonprofit organizations like you, governmental organizations, commercial entities, individuals completing tax return work, all sorts of different services. We also do quite a bit in the accounting service realm where we complete bookkeeping and payroll type of services too. So Brianna, if you want to advance. So our locations, in Wisconsin, we have offices in Green Bay, La Crosse, Manitowoc, Marshfield, Medford, Mequon, and Neenah. And in Minnesota, we have offices in Rochester, St. Charles, and Winona. And today presenting for you, we have several members from our nonprofit services group. We have a great group of individuals. There's currently 12 of us, and we all specialize in nonprofit organizations. We have kind of regular meetings to stay up to date on all their requirements so that we can best serve our clients. So our topics for today, we've got some great topics picked out for all of you. We're going to start off with recording contribution and grant revenue. We're going to move on to in-kind contributions, functional expense reporting, board member responsibilities, and then leases under ASC 842, which is effective for 2022. So our first topic, recording contribution and grant revenue. So I've got a couple of presenters here for you. So Brianna Peters, who is a partner in our Green Bay office, and myself will be presenting this topic. So Brianna, do you want to do a brief introduction of yourself here?
Sure. So yeah, I'm Brianna Peters out of our Green Bay office. I focus on nonprofit organizations, for-profits that receive DCF funding and DHS funding, and then do some employee benefit plan audits as well. I've been with Hawkins for 10 years now. Outside of work, I love to travel. We have 3 kids and we'll be going to Disney this year for the first time.
All right. And then I am Brittany Leonard. I am a partner in our La Crosse, Wisconsin office. I've been with the firm since 2015. I graduated from UWL with degrees in accounting and information systems. I work mostly with nonprofit organizations, a lot with private schools, also those that receive federal types of funding. I also work with bookkeeping clients, completing 990s and tax credit entities, and also doing some different DHS, DCF compliance work also. And I live in Holman, Wisconsin here. I live with my husband. I have a 5-year-old daughter, or almost 5-year-old daughter. March 30th will be her birthday, and my 2 little Yorkshire Terriers. So little intro on me. All right. So we're going to get started talking about contributions. This is probably one of the more complex areas of nonprofit accounting. So we'll start with what is a contribution. So formal definition of a contribution: an unconditional transfer of cash or other assets, as well as unconditional promises to give to an entity, or a reduction, settlement, or cancellation of its liabilities in a voluntary transfer by another entity acting other than as an owner. Super clear definition. Contributions can come in many different forms to nonprofit organizations. Probably the most common one is going to be cash gifts coming directly from a donor. Oftentimes you'll receive gifts of marketable securities that are then traded in for cash. Grants, awards, memberships, sponsorships, fundraising is a common form of contribution revenue also. The difficult part about contributions is that contributions oftentimes get misclassified. So contributions can come in the form of a true contribution or an exchange transaction. And because they come in so many different forms, it's often difficult to distinguish what is truly an exchange transaction and what is truly a contribution. If you want to move on to the next slide. So what we want to talk about today is what is the difference between a contribution and an exchange transaction. So first thing, why do we care? Reason why we care is that the recognition between an exchange transaction and a contribution is very different. ASC 606 covers exchange contributions, and ASC 958 covers contributions. Now, most contribution revenue is going to be recognized immediately upon receipt. Exchange transaction revenue, there's more that comes into it. There's certain performance obligations that have to be met before that can be recognized. Now today, my discussion won't really touch too much on the recognition with ASC 606. It's more going to be focused on that ASC 958, the contributions. But what I do want to stress today is the importance of deciphering the two, exchange transactions versus contributions. So how do you determine the difference? The most important thing to do first is to take a look and review the underlying substance of the transaction. Once you've reviewed the terms of the transaction, you've looked at it a little bit more, you need to determine if commensurate value exists. And now what is commensurate value? Commensurate value is equal value flowing between two parties of an agreement. The most typical example of commensurate value is going to be exchanges of goods or services of equal value, probably the most common one. So if this direct commensurate value exists in a transaction, then you need to account for it as an exchange transaction. If there's no direct commensurate value that exists, you need to account for this as a contribution. Now, one thing to keep in mind is that the type of resource provider, the person giving you the money, it doesn't matter. It doesn't matter if it's an individual, if it's a government, if it's a corporation, if it's a foundation. That should never come into play in this. It's really that underlying substance of the transaction and whether that commensurate value exists. So some things to consider when you're determining whether or not commensurate value exists. Now, keep in mind, one single factor does not define whether commensurate value exists. You need to consider all factors, and some factors may end up having some more weight than other factors do. So the first factor to consider is, or the first thing to think about is, a benefit received by the public as a result of assets being transferred is not equivalent to commensurate value. So a lot of times nonprofit organizations receive grants that are written to support a certain objective or a certain mission of the nonprofit organization. Often these grants provide a benefit to the public, but lack a distinctive commensurate value that's being provided between two parties to an agreement. It's also important to keep in mind that execution of an organization's mission does not constitute commensurate value. I know a lot of nonprofit organizations, they receive operating grants, different things like that. there's no commensurate value that exists between those types of things. Now, one thing that may lead to you having commensurate value is if the expressed intent of the transaction is to exchange resources between two entities. Another factor could be if the resource provider, the person providing you the funds, has full discretion in determining the amount that they are going to give you in exchange for some sort of goods or services. So this is confusing, and it can be very difficult to determine really what is a contribution and what is an exchange transaction. So what I'd like to do is go through a couple of examples with you. So my first example, a student is enrolled at a university. The student's tuition charged for the semester is $30,000. The student received a grant in the amount of $2,000 paid directly to the university to be used towards tuition. Now, when we look at the substance of this transaction, there is commensurate value in an exchange transaction that exists between the student and the university. They've signed an agreement. The student is receiving education by enrolling at that university. And really the grant payment just serves as a partial payment against the tuition owed. So this really should be accounted for as an exchange transaction and not a contribution. The one thing that you have to keep in mind is with exchange transactions, one of the very clear, distinct things about it is that there's typically payment for something or to a specific individual where a transaction price is being agreed upon by both parties. And any payments on that contract, regardless if it's coming from another party outside of the two people that hold the agreement together, that would still be accounted for as an exchange transaction and not a contribution. Some very similar situations like this example might be the receipt of payments from insurance companies or Medicare on behalf of a patient. And my second example here, so you have a nonprofit organization that receives a federal grant to offer educational programs to children ages 0 to 5. Students meeting certain income requirements may apply to the program. Now, this exemplifies a benefit to the general public where there is no direct commensurate value being received. The grant payment being received is not directly meant for one student in particular. It's meant so they can offer this program to low-income families that may be in an area. So in this circumstance, this would be accounted for as a contribution. The one thing to keep in mind is that that grant payment isn't tied to any specific individual. It's meant to fund a program, and that is going to be your distinction of what contribution is. So now moving on to our next slide. So when ASC 958 initially came out, in our experience, we saw some pretty significant changes in certain organizations and how their membership revenue was recognized. When this guidance in ASC 958 came out, what we saw is that memberships in particular can be exchange transactions, they can be contributions, or sometimes they're a combination of both of those things. Oftentimes in nonprofits, the term members, it's used broadly, but really refers to ultimately their donors or their funders of the organization. In certain cases, members may pay dues to a nonprofit organization, which in turn doesn't directly benefit them in any way. So it's important that we take a look at membership benefits being received to determine if that direct commensurate value exists. And one of the important things to look at is really look at the benefits, or I guess the lack of benefits that are being provided as part of the membership, to determine whether or not there's that equal value, that commensurate value occurring between the member and the nonprofit organization. So this next slide here, this is a nice chart that they put out. It's got several indicators and what indicators of a contribution transaction would be, and what indicators of an exchange transaction can be. And I've found this useful in doing the determination of whether or not membership revenue is an exchange transaction versus a contribution. Now, though, one thing to keep in mind is there's no single indicator that determines whether it's a contribution versus an exchange transaction. You may run into instances where you've got indicators under both the contribution and the exchange transaction. So then what you'll need to do is decide which factor is more significant. So I want to touch on some of these indicators. I'm going to break it down by each of these categories. So Brianna, if you want to advance to the next slide. So let's take a look at memberships that are contributions. So some common indicators of membership dues that would qualify as contributions. Here's some things. Just dues are being used to provide benefits to the general public or the nonprofit organization's service beneficiaries. Benefits to members are insignificant. The nonprofit provides services to both members and non-members with the membership funds that it receives. The duration of the membership benefits are not specified. Payment is not refundable. So when you sign up for your membership, you make your payment, even if you ended your membership early, that money is not refundable. And if the membership is available to the general public. And then let's take a look at some of the criteria that would make it an exchange transaction, or some of the indicators here. So dues are being used to provide benefits to members or to other entities or individuals related to members. The members' benefits, so for example, publications, admissions, education programs, special events, they may be available to non-members for a fee. Nonprofit benefits are provided only to members. Duration of the membership benefits is specified. Payment is refundable if the membership is withdrawn. And membership is available to individuals who meet certain criteria. So I want to go through a couple of examples. So the first one I want to talk about, so we have a Convention and Visitors Bureau. Your members consist of various businesses. As a part of their membership, they may get their name advertised on a website or in a publication. Overall, the mission and purpose of the Bureau is to increase overall tourism in a community. So let's take a look, and I want to go back one slide here, Brianna. And we're going to take a look at these contribution criteria. So in this situation, so the dues here are being used to provide benefits to the general public. That is a true statement. The dues that are being paid to increase tourism in an area or increase tourism in a community. The second criteria, benefits to members are insignificant. In this case, I would say there is no direct benefit being provided to the members, or it's going to be very hard to value. Really, the benefit that the business is receiving is an indirect benefit, and that comes from the increased tourism and maybe the increased business that they get as a part of funding this Convention and Visitors Bureau. So I would say in this case, there is no direct benefit being provided. So that would also be true. The nonprofit provides service to members and non-members. Again, this is the case. It's to benefit the overall community and not a specific organization. Duration of the membership benefits are not specified. So let's say in this case that the duration of the membership benefits, they were specified. So you sign up every year, you get an annual membership that runs January 1st to December 31st. There, yes, the duration is specified. However, I would say just meeting that or not meeting that one criteria is not enough to push you into the exchange transaction category. So that's going to be one of those situations where, again, maybe you've got some characteristics of a contribution, some characteristics of an exchange transaction, but I would say overall the duration of benefits would be fairly insignificant in terms of that. And then again, payment is non-refundable. I would say that's kind of a moot point in this situation. And then the last thing, membership is available to the general public, and that would be a true statement. So in the case of, or in this certain scenario of a Convention and Visitors Bureau, given the facts and circumstances that have been presented, I would say this would be recognized as a contribution transaction. So now let's talk about another common membership that we see. So let's look at a fitness center membership. Here you've got members signing up for use of a fitness facility. They may or may not use that facility, but they have the rights to come and go and use the facility as they please. So in this circumstance, let's take a look at some of these exchange transaction criteria. So in this situation, dues are being used to provide benefits to members or to other entities or individuals related to members. That is a true statement. The dues that you're paying are so that you can utilize the facilities. Member benefits may be available to a non-member for a fee. Most fitness facilities, they have different day passes, and really anybody has the right to come in for a fee to use that facility. So I would say that's true. The organization benefits are provided only to members. So again, you have to be a member of the organization to receive that benefits. I would say that is also true. Duration of the membership benefits is specified. I would say that is true. Payment is refundable if membership is withdrawn. This may or may not exist in that type of a transaction, but again, I would consider that probably, considering all of the other criteria that have been met, I would say regardless of whether or not that's true, this would still be an exchange transaction. And then membership is available to individuals who meet certain criteria. That one, again, may not be true, but overall, when you think of a fitness membership, there really is commensurate value that exists in that transaction. The member signs up and they are able to utilize those fitness facilities, so there is direct commensurate value being received. So hopefully those two examples shed some light on membership revenue and how that should be recognized. I know not all nonprofit organizations have membership revenue. I know there are a lot out there. So next, what I want to talk about, so we've gone through the process. We've determined what is our exchange transactions, what is our contributions. So now we get to go down another kind of rabbit hole here with contributions. And we have to determine, is our contribution conditional or is it unconditional? This is going to affect the recognition of that revenue. So what is a conditional contribution? So conditional contributions have two criteria that exist for it to be considered conditional. So the first criteria is that there is a barrier that the nonprofit must overcome to be entitled to the resources. And the second one is that the contributor retains a right of return for the resources provided. So essentially, if the nonprofit doesn't spend the money on the intended use, then it has to be returned to that resource provider or to that person that donated it. Both of these criteria have to be true in order for a conditional contribution to exist. You can't have one exist and not the other. And it is very common with nonprofits that receive contributions that one of these is true, but the other one isn't. So you have to make sure both are met for it to be considered a conditional contribution. So one of the more complex areas of this, let's talk about the barrier. What is a barrier? So do you want to advance one slide, Brianna? So the existence of a barrier is subject to judgment. Possible indicators of a barrier might be these three things: a measurable barrier, limited discretion in the conduct of an activity, and requirements related to the purpose of the agreement. So a measurable barrier, typically these are often performance related. So one example that I'll provide would be you were given a grant to assist your food shelter, and you are required to provide 1,000 meals per month. And if you don't provide those 1,000 meals per month, you would have to repay the money. That would be a great example of a conditional contribution that exists. So limited discretion in the conduct of an activity. So this is when maybe is an agreement that might place a limit to the discretion in how the activity may be conducted. So one example of this that we saw a ton over the course of the last couple of years here is a grant that can only be spent on costs incurred to prevent and respond to the coronavirus pandemic. Most federally funded contracts are going to fall under this category because there's discretion on what you can and can't spend the money on. When you look at the different cost principles and allowable activities, unallowable activities, different percentages on what you can spend on your administration, those are all clear things that kind of limit the discretion in the conduct of the activity that you're performing. So the other one is requirements related to the purpose of the agreement. So an example of this might be an agreement that requires a homeless shelter to construct a building addition with a specific amount of sleeping capacity, or maybe there's specific square footage requirements tied to that. So the big thing to take away from this is that it has to be very specific things in order to meet the barrier requirement. One of the things that they were very clear of in the language is that stipulations that are just administrative, so the filing of an annual report or the filing of what you ended up spending the money on, those type of things do not constitute a barrier. It's got to be certain kind of performance obligations or things that you have to achieve, things that you have to do in order to retain the rights to that funding. So here's kind of a good example, and I'm going to evaluate it both ways, so with a barrier and without a barrier. So say you get a grant to a homeless shelter that requires you to provide at least 5,000 meals to the homeless. The grant contains a right of return for meals not served. This is a clear demonstration of a barrier and a right of return. So this would be a conditional contribution in that circumstance. Now let's change this up and let's just remove the requirement that they have to provide 5,000 meals to the homeless. So you get a grant to a homeless shelter to be used to provide meals to the homeless. And there is no right of return for the meals not served. So if that's the case, we've removed that barrier component. We've also removed that right of return. So in that case, you just have an unconditional contribution. Now, again, I have to stress the barrier and the right of return of funding has to exist in order to make your contribution conditional. So next up, let's talk about the revenue recognition with these. So revenue recognition for an unconditional contribution is pretty simple. It's recognized at the time that the contribution is made or received. And when we say is made, what we're going to talk about on the next slide is some of you may receive promises to give where maybe you're not given any cash or anything up front, but you've been awarded a grant or maybe somebody's promised to give you a contribution. That's when you record it, when it is made. Conditional contributions are going to be different. These are going to be recognized once the conditions are met. So in that previous example, once you've provided those 5,000 meals to the homeless, once you've achieved those objectives and you're to the point where you know that you're going to retain that money and that it doesn't have to be returned, then at that point in time is when you are going to record that as revenue. Now, it is very common for an organization maybe to get a conditional grant where they get the money up front. If this is the case, when you receive those assets, you're going to record that as a refundable advance liability until you meet all of the conditions that you were required to retain that money. So if you do require audited financial statements, conditional contributions, they do require additional disclosure in your financial statement. So it's important that you're doing these evaluations and making it clear which contributions are conditional. And then the last thing that I want to talk about today, and then I'm going to turn it over to Brianna, is unconditional promises to give. So often donors will make a promise of a future gift to an organization. This is referred to as a promise to give, or You could also potentially be awarded a grant that maybe isn't paid to you up front, but you'll get it in the future. These are going to be examples of promises to give. You're not receiving any money right away, but you're receiving a promise that you'll get money in the future. Now, some of these they're mostly seen or most commonly seen in capital campaigns or different types of fundraising campaigns where you're raising money for a certain purpose, maybe even annual campaigns, those types of things too. Now, if these contributions that you're getting are unconditional, as we've evaluated with that previous criteria, with the barriers and the right of return, these promises to give should be recognized when they are received. So you'd have a receivable on your books and you'd have some contribution on your books. Now, the important thing, I know it's very, very common that maybe a donor will make a verbal commitment. You do need to make sure that you have sufficient evidence in the form of verifiable documentation that a promise was made and received. Now, that doesn't just completely throw out verbal pledges. There are still circumstances where you can record verbal pledges, but you've got to have good documentation, maybe in the form of minutes, that would be verifiable, and the donor would need to also be willing to confirm that pledge exists. Now, we really try to encourage, and Brianna's going to cover this in her slides, that you do have some written documentation from donors in these circumstances, just because it makes it a lot more clear, and you have an agreement, even though it may not be legally binding. You've got an agreement there to support any sort of unconditional promise to give. And then the last thing too is, if your pledge is expected to be received in greater than 12 months, present value techniques should be used to determine the fair value of that pledge. So that was all that I wanted to cover today. Again, we start out with a great topic right off the bat. Brianna's going to talk a little bit more about contributions. I'll turn it over to her.
Thank you. So now that we've gone over exchange transactions versus contributions and then conditional versus unconditional, we'll focus on restricted contributions and other considerations with contributions. So donors are the only people that can restrict a contribution. Board members and management can designate funds, but those funds will be shown as net assets without donor restriction. So that's just one thing, make sure that when you are looking at your donations and classifying them, that only the donors can be the ones to restrict the funds, and that is what is shown as the net assets with donor restrictions. Restrictions can be either purpose restrictions or time restricted. So purpose restriction could be something like a specific program. You are required to purchase equipment. Restricted for the endowment, things like that. There's a specific purpose assigned to that restriction. There's also a time restriction, and that's just a restriction on the spending of the funds. So most common example there we have is promises to give. You don't receive that money right away, so there's a time restriction on when that money is received, and then when you can spend it. So that's the most common time restriction that you'll have. You want to make sure that you obtain and retain proper documentation for all contributions, especially restricted ones. So we always recommend having any donor communications, whether it's a letter, an email, anything like that. Keep that, as well as copies of the check stubs. Sometimes in the memo line, they'll say what the restricted purpose is, or it'll say payment 1 of 3. Anything that has documentation related to the purpose of the donation, and if there's any ongoing donations where they're making a multi-year pledge. If they restrict something verbally with you, we always recommend to get that in writing, just so years down the road it's not questioned. It's always better to have everything in writing and keep that related to contributions, just so if you're not at the organization 5-10 years from now, someone can go back and have some type of documentation on why something was recorded the way that it was. And then you also want to keep documentation on the spending of those restrictions. So whether it's invoices for expenses, fixed asset purchases, you really want to make sure you keep all of that documentation. And if you are using employee time to release the restriction, you know, some of these, if it's restricted for a certain program, you might just have employee time that is being covered to release that restriction. So you want to make sure you keep the time cards and payroll showing that that employee's time was spent on that program. So it's just really important to have that documentation just so it's not questioned down the road if the money was spent on the intended purpose. So proper documentation of contributions is extremely important. Without proper documentation and a tracking system, donor funds could be mishandled or spent on items not intended or not spent at all. So different ways to consider tracking the restrictions in spending. If you use QuickBooks, setting up classes for the restricted items, tracking the expenses in those classes, you're still going to be required to have a method to track funds that are carried over from year to year. So if you get a $100,000 contribution in the current year and you only spend 50,000 of it, you still have 50,000 that you need to spend out next year. So just make sure that you have a method to track any carryover of funds. Another common way for nonprofits to track restrictions is Excel spreadsheets. So just have an Excel spreadsheet for all of your restricted contributions. You can have multiple tabs across the bottom for each purpose. Have any money that comes in, you know, have that as a restricted contribution, and then you can track the spending there. That way, if you do have funds that carry over from year to year, it's all right on that spreadsheet, and you don't have to have a separate way to track those carryovers. QuickBooks also has projects that you can use to track restricted contributions, so that's another method. Make sure when you are doing this, you're not netting revenue with expenses. We want to make sure that you're showing the gross revenue and the gross expenses. If you're netting everything, that won't show the true activity for the organization, especially if it nets down to zero. You really wouldn't even show that you have those contributions and expenses. So you want to make sure that you have separate general ledger accounts for all the revenue and expenses. And then don't have one expense account for all the spending. So an example would be if you have, say, ABC grant revenue, you don't want ABC grant expense. You still need to break out the spending by natural classifications. You want to make sure that if it's like program supplies, you record it to program supplies. If it's wages, that should go to wages. You don't want to group all of this spending on a grant into one expense account. So at some point in time, you may consider doing a capital campaign. It can be a big success for organizations, but it can also be a significant amount of work. You want to make sure you have upfront planning. That's going to be key with capital campaigns. And the big thing is accounting and development need to work together from the beginning. And then there should be constant communication throughout the whole campaign process. So development has the contact with all of the donors. Development doesn't always think like accounting, so you want to make sure that they are getting proper documentation for all pledges related to the capital campaign. Similar to what Brittany said, is that we want it in writing. That's the strongest evidence for a contribution promise to give, is to have something in writing. And just make sure that we're following GAAP when recording pledges. Then campaign budget should be set up front, and it should be clear on how funds will be spent. Don't change the budget over the campaign period. So once you have your campaign budget set, don't start moving buckets around in that campaign. It just doesn't send a clear picture to donors on what their funds are going to be used on. You also want to be clear if campaign costs are going to be covered in the budget. So depending on the size of the campaign, some larger campaigns generally have campaign consultants. And you want to be clear to donors if their money that you're raising on that campaign is going to be used to cover the campaign consultant costs. So just another thing, as you're doing the campaign, have those discussions on, you know, the intended purpose of the dollars and how they're going to be spent. You don't want donors finding out that you raised all this money and then, you know, hundreds of thousands of dollars went to cover the campaign consultant. And then tracking is going to be huge here, as capital campaigns tend to span over multiple years, and then the spending of those dollars can also be multiple years. So make sure that you have a good system in place to track all of the restrictions and then the related spending. As an organization, you may be approached to receive a donation of stock. This is a good way for donors to donate appreciated stock and also receive a tax deduction. So the nonprofit should record the stock on the date of the donation. So as an example, if you receive a stock donation of $100,000 in value, you will debit your investments and then credit contributions. So you'll record that at the $100,000 value. Then when you subsequently sell the stock, you will record it at the sale price. So as an example, if you sell it for $110,000, you have a $10,000 gain there. So your entry to record that sale would be debit cash for $110,000, credit the investment to remove that investment for $100,000, and then you're going to have a gain on sale of stock for the $10,000. So that gain is picked up. The donor does not get recognition for that $110,000 sale. They only get the recognition for the value on the date of the donation. And then on the opposite side, if you sell it for a loss, you would say a $90,000 sale on the $100,000 stock. You would debit your cash for $90,000, credit your investment for the $100,000 to remove that, and then you'd have the loss of $10,000. The donor would still have, you'd have that contribution of the $100,000 because that was the value on the date that it was donated. So most of the time, if you sell the stock the same day it's received, there's going to be very little fluctuation in that value. So there's not, it's generally not material where you have to really break out the gain or loss on the sale of the stock. But if you do hold it for a length of time, it could result in a significant difference. So that's really where it comes into play, making sure that you get that contribution recorded on the date of donation, and then any subsequent increase or decrease that is recorded as the investment income. And then just a reminder, when you are sending thank you letters to donors for gifts of stock, you don't give the value in that thank you letter. So in the example I have, you wouldn't say that it was $100,000 value. All that you would say is thank you for, you know, X number of shares of ABC stock. You wouldn't give them anything else other than that. It's on them to determine the value and what their tax deduction would be. So you just send the thank you letter with that information, but don't assign any dollar amount to it. A lot of nonprofits do campaigns at the end of the year. Sometimes it can be hard to properly record with holidays and employee time off. Everybody likes to take time off right at the end of the year. So the big thing with year-end donations is proper cutoff procedures to get them recorded in the proper period. And you'll want to make sure that you're consistent from year to year. So once you set up your practice for recording year-end donations, just make sure you continue to do that each year. Don't change it every year on how it's being recorded. So as Brittany mentioned, you'll record contributions when pledged or received. So if someone is at the office on December 31st, that's going to be the easiest way to make sure that all contributions get recorded in the proper period. Anything that, you know, comes in the mail on December 31st, that would get picked up in that calendar year. And then anything that you receive in January, that would be recorded in January, unless if you knew that it was coming, say the donor called and said, hey, I'm going to make a $1,000 pledge, it'll be coming in January, then that would be recorded. But generally it's, you know, when you guys receive it, that's when you should be recording it. So if someone can't be there on December 31st, we generally recommend using the postmark date. Most often there's not that much lag in the mail system. It's been worse with COVID, but as a general rule, the postmark date can be used. And then credit cards is when the payment is fully approved by the credit card company. So once you guys receive that money from the credit card company, that would generally be when it's recorded again, unless if there was a pledge that you knew it was coming ahead of time. So really, again, on year-end donations, it's just making sure that you have a system in place and then sticking to that. So don't vary year after year on when things are getting recorded. Now, Emily is going to talk about some in-kind contributions.
Actually, Emily, before you start here, I have one question that popped up that maybe Brianna, you want to take a shot at? So the question is, we do a big silent art auction every year where artists donate pieces and then we sell them via silent auction. Is there a specific way I should record this?
Yeah, so in-kind donations, so if those items are donated to you, when you receive the donated items, you should debit some type of asset account. So whether it's inventory, anything like that, assign the value to it. So say that the item is $10,000. So you'll debit an asset for $10,000 and you'll credit contributions. Then if you sell those items at auction, say for $15,000, you will debit your cash for $15,000. You will credit your asset account, whichever asset account you recorded that auction item in, for $10,000. And then you're going to pick up an additional $5,000 of contributions. So in the end, you end up only recording the donation of $15,000 at the sale price. So some nonprofits just skip that whole recording up front of the auction item that is donated, and they'll just record at the end the sale price because that is what it comes down to. And it would be the same thing if you thought the value was $10,000, but you only sold it for $5,000, you would go against the contribution account. So you would really only record that $5,000 contribution of the sale price. So that's why sometimes it's just easier. Don't record anything of donated items and just record it once it's sold, because that's going to be the end value that is recorded. Does that answer? Hopefully that answers the question.
Yeah, that was a great answer, Brianna. I got one more for you, and then we'll move on to in-kind contributions. So our donation database also processes credit card payments of contributions. We receive a payment from the database company with a processing percentage already deducted. Should we be accounting for the payment of credit card processing even if we don't ever make a payment to the credit card processing company?
Okay, good question. I think I can answer. Hopefully this answers the question. So if you have a donation, say it's $100, but you get a credit card fee taken off of that. So say the credit card fee just for ease is $5. You're still going to record a $100 contribution, and then you will record a fee of $5. So your journal entry would be debit cash for $95 because that's the net amount that you're going to get. You would credit your contribution for the $100, and then you will debit your credit card fees or whatever expense account you have for the $5. So that's how it would work if you guys are actually having to pay that fee right out of the donation amount. The other thing that this kind of brings up is, a lot of the online giving platforms offer the donor to cover the fee. So technically the donor is actually donating say in this example, they would cover the fee of $5. The donor is actually donating $105. So you would, in that case, if the donor covers the fee, you would debit your cash for $100 because that's the net amount that you're going to get. You would still credit your contribution revenue for $105 because that's the donation amount. And then you would debit your fees for the $5 to show that you still had that expense. It was just that the donor covered that expense for you. Hopefully that answers that one.
Yeah, another excellent answer. Thank you, Brianna.
No problem.
But right now we'll have in-kind contributions, and Emily is going to step in and cover that for us.
Good morning. My name is Emily Donahue. I'm an audit manager in our Green Bay office. I graduated from St. Norbert College in 2015, and I've been working for Hawkins Ash since 2016, so about 6.5 years. I work on not-for-profit audits, private schools that receive funding from the state, 401k audits, and some credit unions during this time of the year. And my husband and I are expecting our first child in May, so we're very excited about that. Okay, so definition of in-kind contributions. These are donations of non-financial assets, including goods and services. They can include fixed assets, such as donations of land, buildings, equipment. It can be use of fixed assets or utilities, such as like rental space at a discounted rate. Could be donations of materials and supplies that are used in programming, donations of intangible assets, donations of services, and unconditional promises of those similar assets. So contributed services, this is basically the definition. If you receive services at a discounted rate or for free, pro bono, these are kind of the requirements to use to recognize those contributed services in your financial statements. So you recognize contributed services if the services provided create or enhance non-financial assets, if they require and are provided by individuals possessing specialized skills, if the services would typically need to be purchased if not donated. So something creates or enhance non-financial assets if, say, you receive, you're doing a building project and you might receive concrete for a project as a part of a new fixed asset that would be considered a service. Require and are provided by individuals possessing specialized skills. So typically they have probably a college degree. You may pay a relatively or a fee for them otherwise. So they would need to be purchased if not donated. Some examples of that would be accountants, lawyers, teachers, and similar other similar services. Along those lines, volunteer time is not recorded as in-kind service contributions in accordance with US GAAP because it does not meet the requirements above. So typically if you have volunteers that are coming in and donating their time to help with, maybe it's sorting food at a food pantry or helping clean up after an event, you wouldn't typically pay somebody for that. They're not offering a specialized skill. And so those are not recognized as in-kind service contributions. How to value in-kind contributions. These can be goods or services. So they're valued at fair value on the date the contribution is received. And fair value is described as the price that would be received to sell an asset or paid to transfer a liability in an orderly transaction between market participants at the measurement date. So basically, if you would have to pay for those goods or services, what would that price be? And that's what should be recorded as the in-kind contribution in your general ledger. The best way to determine fair value for in-kind gifts received would be to obtain an invoice from the service provider stating the amount that would have been charged to the organization for the services or the goods provided. If somebody donated, common thing would be attorney fees. If you have pro bono attorney fees, they typically would invoice you and show the discount amount on their invoice, similar to accounting fees for services. If you had fixed assets, maybe construction costs related to a large project, they will show that donation cost, and that's typically the amount that's recorded as an in-kind contribution. Brianna touched on this last in her question regarding fundraising items. So they're valued at using the final amount received from the sale or raffle of the item and should be recorded on the date of the sale. Brianna mentioned you can record the asset and the contribution when it's received and then record additional contribution revenue when it's sold, or record the full amount as contribution revenue and in-kind on the date that it's sold. Either way is sufficient. Some more specific examples and common examples of gifts in kind that we see or you may have: contributed advertisement and radio time, contributed use of facilities and utilities. Again, this would be if you receive office space at a discounted rate, you would record in-kind rent for that space. Contributed personnel costs from an affiliate. So if somebody is providing a accountant to assist in your bookkeeping, you would record that. Contributions for fundraisers, that would be those raffle items, auction items, maybe even food or other services related to fundraising events. Contributed administration costs, contributed collection items, and below market interest rate. So if you have a note payable with a bank or a credit union and the interest rate is 4.5% and they're giving it to you at 1%, you would record in-kind interest for the difference of that 3.5% that you would otherwise be obligated to pay. So effective for periods beginning after June 15th, 2021, so fiscal years beginning July 1st, 2021, or year ending June 30th, 2022, there's a new accounting standards update that is effective related to contributed gifts in kind or non-financial assets. And the purpose of this standard update is to increase transparency about contributed non-financial assets through enhancements to presentation and additional disclosure requirements. So basically, it just has some requirements for footnotes and financial statement presentation and impacts the reporting of in-kind goods and services so that readers of the financial statements can more easily see those contributions and their impact on the not-for-profit. There's no change in how to record gifts in kind or how it's valued. So you'll only see these changes in your financial statement presentation. Next slide, please, Bree. Okay, so just to go through the requirements of the new standards kind of at a high level. So the first one is that on your statement of activities or your profit and loss statement, the contributed non-financial assets should be presented as a separate line item in the statement of activities. I think on most of our financial statements that we present through Hawkins-Ash, you'll already see this as a separate line, so you shouldn't notice any big differences here. But if it was included in contributions or other line items, it will be broken out separately going forward. And then the disclosure requirements, you'll be required to disclose in-kind contributions by category of non-financial asset. And I do have some examples in the next slide, so I'm just going to kind of go through what's here. And then for each category of non-financial asset, you'll be required to disclose the following. So the organization's policy about if gifts in kind are utilized in programming or if they're sold for money or contributions. And if you sell gifts in kind that are received, yes, if you sell gifts in kind received or use them in operations when you're able to, a policy related to that, and that will have to be disclosed. You'll disclose information about whether gifts in kind were used or sold during the reporting period. If they were used, a description of the programs or activities in which they were used for. A description of any donor-imposed restrictions associated with gifts in kind, how the fair value was determined for gifts in kind, and the principal or most advantageous market used to obtain fair value measurements. If it's a market in which the recipient organization is prohibited by donor-imposed restrictions. I don't foresee that being very common in a lot of not-for-profits, but it will be a requirement if it applies. Next slide, Brianna. So here's an example of the updated disclosure. You can see the first part there breaks out contributions by category. So it might, it'll be contributed services, and that may even be broken down more specifically, maybe between accounting, contracting, attorney or legal fees if it applies. Maybe you have in-kind supplies and then in-kind rent, basically just similar items broken out into lines. And then that total will tie to the total on the statement of activities. Next will be the policy about if the organization monetizes or uses the gifts in kind. So this example says that the organization's policy is to utilize assets given to carry out the mission of the organization. If they receive an asset and they're not able to utilize it in the normal course of business, the asset will be sold at its fair market value as determined by appraisal or specialist. The fair value determination for contributed services. Basically, contribution services are recognized as in-kind at their estimated fair value if they create or enhance non-financial assets or they require specialized skills. Again, that's that definition of contributed services. It says that the organization receives contributed professional services that are reported using current rates for similar types of services. And they receive a significant amount of donated services from unpaid volunteers who assist in fundraising and special projects, but no amounts have been recognized for those volunteer hours. The policy for determining fair value for contributed supplies, contributed rent, basically using wholesale prices and rent would be looking at properties with similar terms and similar qualities to record the market value of that rent and whether the gifts in kind were sold or used during the reporting period. So in this case, we're saying that they were all utilized, but if anything was sold, that would be disclosed here. That's all I had. Thank you.
Thanks, Emily. So I have one question here. Is the donor of in-kind setting the in-kind donation amount, or would the nonprofit have to put a value on it? So I think Emily kind of elaborated on this as she got further into some of her slides. But ultimately, that would come down to the nonprofit to do it. You need to make sure that everything is being recorded at fair value. Your methods are going to vary based on whether it's in-kind services, whether it's a tangible piece of some kind of good. So it's going to depend, but essentially it comes down with what would it cost you to go out and purchase that just in the typical market.
Typically, we also say that if you're writing thank yous for in-kind donations, the value shouldn't be included in that thank you. It's just an overall thank you for the donation of the good or the service.
All right, so, oh, we got a couple more questions that popped up here. So is there a proper way to record in-kind donations in QuickBooks? I guess QuickBooks isn't going to be any different than general software. So if you are getting an in-kind donation and you're simultaneously utilizing that, you would just, I would say probably the easiest way in QuickBooks to do that would be using the general journal entry feature, where then you would credit your in-kind contribution revenue and debit your in-kind contribution expense account. All right, so I think I'm caught up on questions here. So next we're going to move on to functional expense reporting. And again, thank you for those that are asking questions. We love to answer these, so keep them coming. And Sandy's going to take over and present functional expense reporting.
Okay. Hello, everyone. My name is Sandy Jensen, and I am a partner in the La Crosse office. I've been with Hawkins Ash ever since I graduated in 2001, so it's about 21 years. Most of my practice has been focused on non-for-profit auditing, although I have done a little bit of credit unions as well. And a little bit about myself. I'm married. I have 3 daughters that are also married as of last year, and I have 3 grandchildren. So a lot of my time is spent being loved by my grandchildren, which is just a joy. So I'm very excited to share with you functional expense schedules. And so we'll get right to it because I'm the last thing before the break. So one of the reasons that, like, when I look at something, it's like, why is something important? So functional expense schedules are important, well, for one, because they're required. And so as of historically, functional expense schedules were not required unless you were a voluntary health and welfare organization. But with the new standard that came about in 2016, the large change in non-for-profit financial reporting, it required that a functional expense schedule be shown either on the face of the financial statements or as a part of the general financial statements or as a footnote. So a supplemental schedule was no longer an acceptable viewpoint. It had to be as part of the general financial statements. Another reason that it's important is that the Federal Form 990 Part 9 also requires for most nonprofits you to show your expenses for both in a natural classification and by a functional classifications. And then also the state reporting forms require that functional expense reporting be shown as well. But not just because it's required, there's also another important reason to show functional expenses, because they can provide a realistic picture of the cost of the different programs. So for example, you can use a functional expense schedule to analyze your expenditures and kind of determine whether, you know, are you spending too much of your resources on program, and then as a result of that, are you under spending resources in technology or in personnel? Are you pushing your personnel too hard to have your program outcomes? Or on the other hand, if you have too little program expenses, are you being inefficient with your resources? So functional expense reporting helps you to kind of look at how you are spending your resources. Okay, I'm ready for the next. So when we talk about natural classifications versus functional classifications, if you think about your natural classifications, that's really grouping expenses as to what kind of expense it is. So that's pretty easy to think about. Like, is it a salary expense? Is it benefits? Is it, you know, postage? Is it rent? Those are typically what we think of when we think of expenses. Functional classification really talks about, as I alluded to on the previous slide, how we spend the money and how it is utilized in the organization. And then another thing to think about is sometimes it's very easy to think about how you're using those, because it may be the only sometimes it's helpful to think about whether or not this is a program activity or a supporting service activity, or is that expense both? And we'll talk about how to go about allocating certain expenditures that way. I think that it's helpful to have, when we're talking about things, to have a picture. So if you look at the next slide, this is typically how we see a functional expense schedule. So we typically have a statement. Sometimes we'll have a separate statement of activities, and then the financial statements will have a functional expense schedule, and then they typically will tie out to one another. Sometimes if it's a smaller organization, you'll have the detail all shown on one statement. In a larger organization, we tend to show the statement of activities, and the statement of activities will just show like program expense totals, management expense totals, and fundraising expense totals. And then on the next page, you'll see a functional expense schedule, which will show the detail in the program activities and the supporting activities. So usually you'll see your natural classifications to the left side of a functional expense schedule, and then the functions will be up at the top, and they'll be separated by program and supporting activities. And I'll talk a little bit about each of those, but I wanted y'all to have a picture in mind while we were talking about that. Okay, so the next slide. Program activities are activities that are carried out by the organization to fulfill the organization's mission. And supporting services are activities that generally support your programs, or basically how you run your business. So for some organizations, as the previous slide, you could have one program and then or you could separate out your specific programs. So like, for example, a smaller organization may just have one program, and then they'd have management and general and fundraising, whereas a larger organization, it might be beneficial to them to show separate programs. Like, for example, I think of like a Habitat for Humanities, for example. Typically they have a restore in their organization. So and they may build houses, and they may also do some home repair for certain individuals. So for them, it might be helpful to break out each of those activities. In your financial statements, when you do whatever your program revenue is, in note 1 to your financial statements, you should describe what the nature of the activities, or basically describe those programs. So for example, if you break out in your functional expense schedule different programs, you should have a description in your note 1 to the financial statements that basically describes each of those programs. So let's go to the next slide. Management in general, there's kind of a myth out there that all of your energy should, or all your resources should be put to program services. And depending on your organization, that may or may not be true. You can't have a good organization or a strong organization without spending some money in management in general, because that's where you're providing your oversight. So management in general is supporting activities that are not directly identifiable to one or more program, fundraising, or management development activities. These typically are, you always see accounting and human resources under management in general. And then you will see some oversight should be, or some planning or some strategy should be spent there in management in general. So anyways, go to the next slide, then we'll talk about fundraising. Fundraising activities are supporting activities which induce potential donors to contribute either money, securities, or non-financial assets to the organization. And you typically see those in conducting fundraising campaigns or maintaining a donor list, fundraising events. And one thing that's commonly is a common mistake in reporting in your functional expense schedule is joint costs. So joint costs, a great example of that is easiest to talk about joint costs, and an example is a newsletter. So for example, let's say you have a newsletter. If in somewhere in that newsletter you have some sort of a call for money or a donation from the organization, you should allocate some of those costs to fundraising activities. And if you have a newsletter that is to inform the public about an organization or what you're doing in the organization, you have to evaluate whether or not you are, in order to put those expenses to program expenses, you have to ask yourself, are you doing something to call the reader to a specific action? So like I think about like a humane society, for example. If you're sharing with your readers in your newsletter about how your community is overrun with cats, and you're asking everyone to please think about donating or think about adopting a cat, or if you're calling your readers to spay or neuter your animals, that's a specific direction, call to action. And so you could put some of those costs to program services. But if you're just informing the organization, informing your readers to just donate money to help you accomplish your missions, then you should put the majority of that to fundraising expenses. Okay. The next slide is membership development, and we don't see this typically very often. These are supporting organizations that they're supporting activities that include soliciting for members or memberships. And the important part of that is that it's an exchange transaction, like Brittany was talking about earlier. If there's no significant benefits that are provided to members in exchange for their dues, then it's considered a fundraising activity. So when I think of this, I think like a hunting club or a golf club, that memberships allows you to use the facilities, or you receive some sort of reduced fees by being a member of that organization. And if you're not getting, like, again, if you're not getting specific benefits, then it would be considered fundraising activities. So we typically do not see this too often. The next slide is another example of a statement of functional expenses. And I wanted to bring this to your attention because we're really working on updating a lot of our financial statements to show, to give more information on the functional expense schedule. So if you can see, for example, you see your program expenses, and then you see this column that's called cost of direct benefits to donors. Now, when we're preparing financial statements, the standard allows us to have a great deal of flexibility in how we show this. So this example just shows a separate column as the direct benefits to donors. You could also put it in the natural classification line as a special event revenue. The important part of this is the schedule is, so for special events that have direct benefits to donors, or if you have like a gift shop and you have your cost of goods sold, on the statement of activities, that is netted. So for example, if you had a gala, and on your statement of activities, you would show that you would show revenue of $31,000, for example. Now, let's say when you sold all your tickets for the gala, you sold $100,000 worth of tickets, and then on the statement of activities, it would show net of $69,000 of a cost of direct benefits to those organizations. So that would be like your meals and entertainment, that exchange transaction. On the statement of activities, that is netted. So we would show $31,000, and then it would say net of direct expenses of $69,000. And then on the statement of activities, or the statement of functional expense schedule, we would see those expenses broken out. And then on the last line of the statement of functional expenses, we would subtract that out so that it ties to the statement of activities. And it just gives a reader of the financial statements a little bit more detail about where those expenses are being spent. And then also this will mirror the 990. Okay, so how do we go about creating a functional expense schedule? For one thing, any expenses when you're looking at program or management in general or fundraising expenses, any expenses that are direct expenses or that you can clearly assign to either a program or a supporting service, you should do so. And then there are some expenses that relate to either a program. It could be relate to a program activity or it could relate to a supporting service activity. And those would need to be allocated. The standard requires that it be reasonable and consistent in your manner of how you do it, so that you should be consistent in applying it across all expenses. But you could have two different drivers that drive your allocation. So for example, you could use an employee time study. And this is a common method of preparing a functional allocation policy. You could take some different times of the year and have people keep track of their time, and then create a percentage of total time from that. And typically we see the executive director who wears many hats in the organization, for example. So that he or she would be a common person that would be allocated across several programs. So another method to do so would be square footage. So let's say, for example, you're trying to decide how to allocate rent or utilities. Maybe square footage would be the best driver for that. Or it also could be salaries and benefits too. I mean, you really have to analyze your costs and see what's driving them. But once you create a functional allocation schedule, it's really important that you just don't leave it that way forever. So for example, if you're allocating program expenses and you come up with an allocation that's 80% will be to program and 10% will be to management in general and 10% will be to fundraising, that shouldn't be consistently like that for the next 10 years. You should do it every few years, or if you have a major expansion or reduction in programs, maybe it's a time to look again, is your allocation of expenses proper? Or if you add a new program, or for example, if you've had an executive director for years and then all of a sudden they retire and you have a new executive director and they maybe restructure things or restructure people around, then that would be a good time to consider updating your allocation of expenses. And the other thing, the last slide that I wanted to talk about was, it's a good idea to create a policy for your functional expense allocation. For one thing, that's something that will be reviewed every year, maybe at a board meeting or whatever. But it's a good thing to document that, how you came about your allocations. For one thing, your auditors will ask you for how you go about doing that, and they're going to evaluate your methods behind that. But more importantly, for you, the organization, if there's staff turnover or if your accountant leaves, or then there's a roadmap on how you came about that, and it also gives you an opportunity to improve that allocation policy every year. So that's all I really had to share with you today. Does anyone are there any questions, Britt?
I don't have any questions specifically on functional expense reporting at this time. Okay. All right. So what we'll do, I do have one question circling back to in-kind contributions that we'll look at. So the question is, if we utilize a volunteer to run a program that we would pay for, would that be recorded? So this is going to be kind of a tough one to answer without knowing some more details on it, but ultimately you need to take a look at the contributed services definition and see if it falls within that criteria. So are the services by that volunteer, are they creating or enhancing non-financial assets, requiring or provided by individuals possessing specialized skills, or the services would typically need to be purchased if not donated. So I don't know that, it kind of seems like in this circumstance the services would need to be purchased or you'd need to hire staff to do it. I don't know that that alone would be enough. I think you'd have to look at, does it require individuals possessing specialized skills, or is it kind of just in supplement to the staff that you have? So it's going to depend. Again, if it's maybe like accounting services that are pretty specialized, or legal services, that would maybe be something to recognize. But again, I just kind of take a look at that criteria and see if it falls into there. If you have any more specific scenarios too, you can always reach out to us and we'll give you some advice there. All right, everybody. So I do have one functional expense reporting question, Sandy, if you don't mind answering this quick. And this is a good question because I think this stands true for, the question is related to QuickBooks, but I think this stands true for other accounting softwares too. But Sandy, how do I record in QuickBooks that a GL belongs to a program activity or supporting services? And also, along with that, how exactly do you record the functional allocation in the general ledger?
So, well, we've seen organizations do it both ways. You can set up in QuickBooks to have projects and assign specific accounts to that. So for example, let's say you had utilities. So you may have a utilities account, but then you would have to ultimately have 3 projects set up under management and general and program and fundraising. And then let's say once you do your allocation schedule, you would do that through a journal entry. So let's say, for example, you had $100 of a utility bill, and you may allocate that to a certain percentage to each of those specific costs under that project. Other organizations, that'd be the clearest way I could think to really do it, is you'd have to set up a program, for example, a program, and then have a program utility, a management and general utility, a fundraising utility expense. Does that make sense?
Yep. All right. So let's move on to board member responsibilities, and Matt New is going to take over.
Hey, good morning, everyone. Welcome back. Thanks, Brittany. Hope everybody's doing well and hope you're learning a little something. So again, my name is Matt New. I am a senior manager out of our Manitowoc office. Been with the firm quite a while, let's say about 23 years. Practiced over those years in all kinds of different areas, primarily focusing now though in nonprofit employee benefit plans, DHS, DCF funding, a couple other little things here and there. Graduated from University of Wisconsin, Madison, go Badgers. I'm married, have 2 kids. I have a daughter that's actually going to college next year. She hasn't chosen her college as of yet, but let's just say she may be being swayed one way or another, wink, wink. Okay, so I have about 10 minutes allotted to board member responsibilities, and then we're going to turn it over to Chuck for our grand finale, leases, which I know everybody is on the edge of their seat for. It is the new hot standard for 2022 to get implemented, so I won't take any longer than I have to. So, board member responsibilities. Over the years, I've had quite a few discussions with a lot of management, executive directors, CEOs about boards and board members and what they're looking for. And, you know, a lot of times what I'll get is, yeah, we need an accountant, we need a banker, an insurance agent, a lawyer, you know, an HR specialist. Obviously, those are important roles. Often, you know, say that it's even more important at times to have just somebody that is super passionate about the organization and just very engaged. Obviously, those people to me will do a lot of the heavy lifting for a board and just be super involved in the organization. Again, I've sat on a lot of boards, and I've, you know, as an accountant, we're always asked to be the board treasurer, of course. So, but it's really, when I see those people that are super passionate about an organization, they're the ones doing the work. But, you know, what often gets missed is really the overall, what is the board member responsibility? I mean, yes, they play a role if they're an accountant or a banker, but you know, what is their overall responsibility to the organization? So that's kind of what I'm going to look at today. So obviously, as it's kind of defined, boards have a legally mandated fiduciary duty to their organizations. Kind of describe, you know, their duties describe the manner in which the board members are required to carry out their roles. Basically, there's 3 fiduciary duties: obedience, care, and loyalty. You know, so I basically say that boards are there to steer the ship of the nonprofit organization, making sure that it is sustainable and carries out its mission. You know, they basically adopt sound ethical and legal governance, and develop those financial management policies, just to make sure that the not-for-profit has adequate resources, again, to carry out their mission. So if we're looking at the 3 fiduciary duties, the first one is duty of obedience. So the board must ensure that the organization is obedient to its central purpose, as described in its articles of incorporation and mission. I think the big thing there is, you know, that they're obedient, the organization is obedient to its central purpose. The board is really responsible for ensuring that the not-for-profit is maintaining its purpose and advancing its mission, that the organization is following its bylaws and its policies are being followed, and really that the not-for-profit is obeying all of its, you know, required laws and regulations related to its operation. You know, whether it's federal, state requirements, payroll reporting requirements, human resource requirements, other compliance requirements. You know, really the board has that responsibility to make sure that that is all occurring. Duty of care, you know, the boards must be knowledgeable of all reasonably available information before taking action, and then acting with prudence and care appropriate under the circumstances. Really, you know, making the best decisions possible based on all the information that is available to them. And also ensuring that the NFP is using all of its assets properly. You know, obviously not just financial assets, but, you know, assets would include your facilities, your people, the kind of the goodwill of the organization, you know, the community impact they're having. I mean, you just have ensuring that all those resources are being managed appropriately and taken care of. And then really the duty of loyalty, you know, the board must discharge duties unselfishly to the benefit of the organization, and disclose potential conflicts of interest. You know, really here, the decisions that are made by the board need to be in the best interest of the organization and not in the best interest of the individual. I mean, it's kind of one of those things, we all know it, but you know, sometimes it doesn't happen that way. But obviously, the decisions that are made need to be in the best interest of the not-for-profit organization. And I guess for a lot of organizations, you know, when we come for the audit, we're asking about related party transactions, which would be potentially transactions involving board members, making sure those are arm's length transactions. A lot of times we'll review the conflict of interest statements just to see if there are any conflicts that any board members have with the organization, and make sure those are being addressed appropriately. So really, looking at it, these are the full kind of 3 main fiduciary duty areas for a board member. So overall board member responsibilities, boards have 3 essential roles, and the roles are kind of, how the board, the things that the board really needs to do. Okay, so obviously number 1 is policy formation. The board really sets, strong policy, is expected to set strong policy that drives the direction for the organization. Part of that is reviewing these policies, maybe annually, maybe a shorter time frame, and evaluating them and making sure that they're changing policies or adding policies if needed. Decision making, kind of already mentioned that, but it kind of goes without saying that the board is basically there to set all the making decisions with obviously input from management and staff, but they are in their roles to make the best decisions for the organization with the information that is available at that time. Again, kind of with the best interest of the organization in mind. And lastly, the 3rd role there is oversight. Obviously, the board has significant oversight responsibility for all areas of the organization. And if we kind of look to the right there's kind of 5 main areas of what that oversight represents. So mission and strategic planning oversight. So is the organization fulfilling its mission? Are they moving forward? Is there goal setting? Are they developing a strategic plan? Kind of that forward thinking. Where's the organization going to be in 3 to 5 to 10 years? Kind of that whole oversight of what is driving the organization. 2, quality oversight. From the quality oversight perspective, basically, is the organization providing quality services? Quality programming? Are they taking care of their staff? Basically is just all the quality, the community vision that they have. Is everything, up to the level of what is expected in the mission? Number 3, executive management oversight. So again, the board is responsible for putting management in place, hiring that executive director, CEO position, evaluating them on an annual basis, monitoring their conduct and their activities, making sure that, staff are being evaluated by management. So kind of that whole executive management oversight role. Number 4 is usually near and dear to the auditor's heart, is the financial oversight. So again, the board is responsible for kind of monitoring the resources of the organization, and making sure they're properly utilized. Again, making sure that there are resources available for the organization to fulfill its mission. Okay, and we'll get into that one a little more in the next slide. And then lastly, board effectiveness. So I always like to say board members have a responsibility to kind of monitor and reel in other board members. So if a board has an underperforming board member, he or she's not showing up to meetings, not engaged, just kind of, away from the organization, it's the other board member's responsibility to basically address that and kind of make sure the board is acting prudently and appropriately for the overall organization. Okay, so financial oversight. The board's fiduciary responsibility is to protect the organization's financial status so it can meet its obligations, economic and social, to its communities. Meeting these obligations typically involves a variety of finance-related tasks, budgeting, investments, capital, fiscal policy, philanthropic opportunities. So again, the board is got the overall responsibility to drive the financial aspects and the monitoring of the organization. Part of that as well is, a board is going to be pretty significantly involved as a financial control within the organization itself, depending again on the size of the nonprofit organization. So if we go to the next slide, one thing I wanted to show as, again, just as auditors and accountants, when we come into an organization, we have certain expectations, just as management and the staff do from the organization about, the board members' involvement. So from an internal controls perspective, just to kind of take the bullets down there, different roles of the treasurer, the finance committee, and the board. I guess from my perspective and boards I've sat on, obviously you're not going to have everybody as financially savvy on a board as some folks. So it's always good if an organization can develop a finance committee, and probably the treasurer leading that group, that really kind of digs in more into the finances and the financials on a monthly basis. Asking the tough questions, reviewing the details. At the board level, usually, I like to see more of a dashboard, just the big picture topics for the month. Because again, not everybody's going to be as involved and have that great understanding of the financials and the finance activity. And that's where I usually like to see a finance committee kind of dive more into that aspect. Again, monthly financial statement review and approval. The finance committee, and we'll say / board, should be reviewing the finances on a monthly basis, obviously. I know that sometimes you're going to have monthly meetings and you don't do it monthly, but I would say at least monthly, bi-monthly, those financials should be reviewed. Again, any questions asked, monitoring the activity of the organization. Kind of already talked about reviewing of a dashboard at the board level. Approval of a budget. Obviously, the board should be approving a budget, that was, we'll say, created by management and the staff of the organization, with the assistance of the board, but there should be an annual budget approved to guide the organization's finances in that next year. Just so that there are, everybody understands, kind of their expenditures, where we figure the revenues are going to be coming from, and just so then, as we keep going down, that we are using that budget on a monthly basis to compare the actual numbers to, and making sure that things are in line. And if they're not in line, that we can reasonably ask or answer why they're not in line, but the board needs to be asking those questions. Sometimes boards are charged with approving expenses over a certain threshold if those items were not included in the budget. So sometimes those outliers that need to be approved, the number of boards will set a number, and if there's an expenditure over that amount, they have to approve that. Then an annual risk assessment. Not every organization does this, not every board does this, but we always recommend that on an annual basis, the board kind of assesses risk, and not in just the financial statement area, but they'll assess risk with insurance, human resources and personnel, other areas. It could even be facility risk, but there should be a risk assessment done just to see if there's any changes that need to be made, but especially from the financial area. We always, and I'm sure you've all heard this, segregation of duties. We like to see segregation of processes as much as possible between staff. Well, if that can't always happen, then, we usually like to say, okay, the board, with management should look to see if there's any improvements that can be made. Even though you might only have 1 or 2 staff, as part of an organization, what else can be done to help assess risk and address some of our internal control areas? But that is always a function, or a big function, of the board, and should have a good understanding of how things flow within an organization, and where various areas can be addressed for better segregation of duties. And then lastly, just wanted to throw in kind of some of the policies that boards are responsible for. And again, a lot of the organizations we deal with, and a lot of you on this call, have these policies. We think these are some of the more important ones that an organization should have in place. Again, I don't need to go through all of them, but it might be a good idea for your board, if you don't have some of these policies, to maybe consider implementing some of them. They are kind of, like I said, we usually send out a policy questionnaire to see what kind of policies an organization may or may not have, and a lot of times we'll recommend that you put some of these in place. I guess overall, again, as I've said, I've sat on a lot of boards and been part of a lot of boards and have talked to a lot of CEOs and executive directors. And, boards aren't perfect. You're not going to always have, the exact people you may want on a board. And from what I've seen, it's getting harder and harder to find those good people to get on a board. But at the end of the day, I think, it's always good, obviously get the role you need for whether, again, it's HR, accounting, whatever. But I think it's important that a board member comes in understanding what their overall responsibility is, because I think we lack that sometimes. I said the boards I've been a part of, you basically just get asked to join and away you go. And you really don't give it a lot of thought about what your true role is on a board. So with that, I will turn it over to Chuck to take it home with leases.
All right, thank you, Matt. So I am Chuck Krieger. I'm a senior manager in the Manitowoc office. Been with the firm, will be 37 years coming up the beginning of February. My wife and I have 3 children between us and 3 grandchildren, and the youngest one is turning 1 today. So that's my little personal tidbit. So let's jump right into leases. I know you're all waiting for this. Leases, new standard. We had prior guidance and the new standard that's now effective. But this new standard, they talked about all the way back in 2016. So it's been a long time coming. It was delayed a few times with COVID. And I think for the most part, we're going to focus on the lessee side. I would think that most of the people on the call, that's their angle that they would be looking at. So under prior guidance, you had 2 types of leases. Capital leases, it was like the lessee owned the asset and had a liability that they were paying off, kind of like we purchased a building and there's long-term debt associated with it. And then you had operating leases, which really one line item in the statement of activities, rent paid, or maybe an occupancy. Now, the new standard still has 2 types of leases. Finance leases, which is capital lease under the old rules. It's still on the statement of financial position with an asset and liability. And now you have operating leases, but even though no change in terminology, the change is it's going to look more like finance lease. There will be an asset and liability for operating leases now too. There won't be any more rent of the asset. Okay, next slide. Okay, so this is the new guidance, ASC 842. It's a long standard, around 500 pages. It's pretty complex, although a lot of the leases that that you're going to come across are going to be straightforward with standard process for recording them. It's when there's a lot of additional items in the lease that you're going to end up having more complex things. Just beware, you might have a lease even if the contract doesn't use that terminology. You might look for words like monthly rent, monthly payment, easement, usage of XYZ. Those all indicate something that would qualify as a lease under this new standard. So some key concepts that we have to cover to determine if it is in fact a lease under the ASC 842. We're going to be looking at definition. What is reasonably certain? How long is the lease term? Are short-term leases treated the same as long-term, or are they treated differently? You might have a lease that has some extra components to it, like common area maintenance, finance lease compared to operating lease, and lastly, this is one of the standards that materiality comes into play. Next slide, please. So, definition of a lease. A lease is a contract or part of a contract that conveys the right to control use of an identified asset, property, plant, or equipment for a period of time in exchange for consideration. Okay, now this is that exchange transaction that some of the earlier presenters talked about. You're probably going to give up something to get something. In general, you're going to be paying cash for the right to use the asset. Okay, so a couple items parts to this. Convey control. The lessee must be able to obtain the benefits of the asset and how to use the asset. It's like they own it. So if you're leasing a piece of equipment or maybe a vehicle, is there you can drive it whenever you want. You can drive it where you want. You have to have it covered by insurance, all that type of thing. So you have control of how that asset is used, and you obtain the benefits of it. Period of time might be days, weeks, months, or years. Does not have to be consecutive. So let's say you have somebody who's maybe a Head Start program. You're going to lease space in a building for 36 weeks a year while school is in session, and you have a Head Start program there. Okay. Over multiple years, okay, those weeks are not going to be in a row. Okay, you might have 36 in a row, but you'll have time out for Christmas holiday, that type of thing. Then you have an exchange transaction, cash for use of the asset. Now, this goes back to, I think, something that we talked about for in-kind and contributions earlier, donated rent. So if you have a situation where you get a reduced rent for leasing a space in a building, let's say, the donated portion of that is not an exchange transaction, it's a contribution. And they covered that earlier. It's excluded from the lease calculation when you have that. So the lease calculation really is just what you are paying, not what you should be paying. All right, next one. What is reasonably certain? This is factored in deciding if options to extend or terminate a lease should be included in the lease term. Think of it should be a high threshold, 90% or greater certainty. You know, it's almost positive. You're almost positive it's going to be exercised. Lessee should have a compelling economic reason to exercise a renewal option or not to exercise a termination option. So not exercising a termination is almost kind of like a double negative. It means they are going to keep using the asset. You determine this when the lease starts, not sometime down the road. And this same concept about reasonably certain is used in the determining of a finance lease. Next slide. How long is the lease term? Okay, it starts with the non-cancelable period. Okay, where both parties are legally obligated. Okay, the lease says you have the lease is for 5 years, you pay monthly rent, and then at the end it might say with an option to extend or not to terminate. Okay, period when the lessee is reasonably certain to extend the lease, or when they're reasonably certain to not terminate it. Okay, that will be included in the lease term. Periods covered by an option to extend or not terminate at the option of the lessor. Now, the lessor, the reasonably certain concept doesn't apply to lessors. That's strictly from a lessee standpoint. Now, so the lease term, you could have some of this language where they can extend, either party can get out of it, that type of thing. All of those come into the fact of determining how long the lease actually is. Now, short-term leases, are they treated differently? Yes. If you have a short-term lease of 12 months or less, this standard does not apply. Okay. It would not contain a purchase option that the lessee would exercise, so it's not subject to this. Think, if you had something even that was month to month, that would probably not qualify under this because it is short term. There's no legally obligated there. So facts and circumstances are going to determine this. So in some cases, depending on other factors, what you think might be a short term could turn into a long term, just because it would extend more than 12 months. So each lease really has to be looked at on its own. You can't kind of lump them all together. So it's a challenge. Next slide. Okay, contract with multiple components. You can treat them as separate contracts. For example, right to use a building, and then the maintenance services associated with the lease space. Now, if the maintenance is kind of tertiary to the actual rent that you're paying, you could kind of lump those together, call it a single contract, and run it all as a lease payments. The end result is you're going to, over the course of the lease, you're going to have the same kind of net activity had you separated them, but it'd just be easier from a administration standpoint if you do it as a single contract. Okay, so finance or operating, which one is, what are the criteria for that? And we'll go through the financing criteria, and if it doesn't qualify for that, it defaults to operating. So finance lease includes one or more of the following. And if any of you are familiar with the old rules under capital leases, you'll recognize a lot of these. These are very similar to what the old capital lease rules were. You have a transfer of ownership at the end of the lease. Okay, you make 36 monthly lease payments, and at the end of it, the copier is yours or the computer is yours. Okay, simple transfer of ownership. The lessee can purchase the asset at a price which would be reasonably certain to exercise. Under the old rules, this was a bargain purchase option. So, I've got some clients, okay, you're gonna make all your payments, and at the end of the lease, might be a 3-year lease, but it's an asset that might last 5 or more years. At the end of the lease, you pay 10% of the original cost, or you get it for $1. Okay, that's a bargain purchase option, because if you've leased it for 3 years, but you know that it's still going to be able to be used for maybe 3 more or 5 more, and you only have to pay 10% of the cost, that's probably a pretty good deal. You're probably going to exercise that option. Okay, the lease term is a major part, 75% or more of the remaining life of the asset. Okay, this would be more of like a vehicle. You're leasing a new vehicle. A vehicle expect to last, 5 years, 10 years. Let's say 10 years, and the lease term is 8 years. Okay, that's 80%, 75% or more would qualify as a financing lease. Present value of the lease payments. Okay, equals or exceeds 90% of the asset value. So you'd have to run some present value calculations on the 36-month lease, $1,000 a month, discount that back and get a value and say, okay, how does that compare to if what the value of the lease of the asset is when I first entered into the lease? Pretty much a cut and dried numerical calculation there. Now this last one, if you look talking about the old capital lease rules and the new financing lease rules, the first 4 items there are basically the same. The last one is been added under the financing rules under the new ASC 842. The underlying asset is so specialized that there is no alternative use at the end of the lease. Not sure I have a good example about this. This lease standard is brand new. Everybody's implementing it now. And I'm sure at some point somebody will get into a lease for some sort of equipment that, okay, when the lease is over, there's nothing more we can do with it. So it could be a specialized piece of machinery, robotic maybe, or something that is set up just for your business. If you turned around to try and sell it when you were done with it, you'd have very few or no buyers, or no potential buyers. So I think the so specialized no alternative use, I don't think that's going to come into play too often. But again, each lease has to be looked at on its own merits, and there may be some stuff out there that that you will have something that qualifies under this criteria. All right, next one. Materiality is a factor. Okay, so each year you enter into new leases, you would look and say, okay, if we figure out the present value of the lease payments you're on the hook for, is that going to be material to your financial statements? Obviously, larger organizations are going to have a larger materiality. So if you have assets of 5 million, your materiality is going to be a lot different than if you have assets of 500,000. I'd like to say, yes, you have this type of asset, excuse me, it's not going to be material, but the fact of the matter is materiality is as individual as looking at each individual lease. So you really have to look at it and how it compares to your operations. Even a copy may be material to your organization if you're leasing it. So again, we'd look at that annually. Now, let's say you figured out what you have for leases, what kind of leases you have, and did the calculations. Now, I'm not going to go into how you calculate the right of use asset and liability. That's kind of beyond the scope of this program today. But suffice to say, once you have that calculated, then we're gonna show you now where it would come into play on your financial statements. So you have a lease liability and a right to use asset. This is the same for both types of leases, financing or operating. So you start out and it's basically going to be the same calculation, the present value of the payments using the rate in the lease if known, or the lessee's incremental borrowing rate. So whether it's financing or operating, your calculation to start out is going to be the same, and it's the subsequent accounting that's going to be different for each type of lease. Okay, so here's where the some of the items are going to show up on your financial statements. I think they made this a little more complicated than needed because they require, if you have operating leases and finance leases, they have to be on separate line items on your reports. So for the statement of financial position under the other asset area, you may have a line for operating lease, right of use asset, and finance lease, right of use asset. Okay. You know, if I were writing this standard, I would have put them together. But then in the liability section of it, again, you have an operating lease right of use liability, and then the finance portion right of use liability. If you have a classified balance sheet, you'd have current portion and then long-term portion. So you can see the total of the assets equals the current plus long-term liabilities in each case. Next. Okay, statement of activities. For the financing leases, you amortize a right of use asset, kind of like depreciating an asset if you had actually purchased it. And then you'll have interest expense as you write down the liability and make payments on the liability, similar to if you had purchased the asset and taken a loan out. The loan gets amortized over a period of time. Part of it is principal, part of it is interest. Same concept here, just the terminology has changed a little bit. Instead of depreciation, it's amortization. And you can include the amortization of the right of use assets in with your regular equipment and building depreciation and amortization, leasehold improvements and what have you. So kind of cycling back to the other one, they required you to put in a different line item for right of use assets under finance and operating. Here they're okay with you putting in the activity, the amortization, depreciation, and interest expense right in with the with other items. So for operating leases, you'd show lease expense, and that would be included in the non-lease operating expenses. You know, would be right in there with maybe occupancy or your regular expenses for the organization. One kind of little tweak, you'll notice it says you'll show lease expense, not rent. Okay, so they changed the terminology and it's lease, not rent expense. Other than that, pretty much straightforward on recording that in your statement of activities. Next, statement of cash flows. For finance leases, you have principal paid on the financing activity and then the interest paid reflected in the net change in net assets. For operating leases, the lease payments are reflected in the change in net assets. So again, not too much different here than what you would see if you just had a strictly a loan that you're taking out on a piece of equipment or a building that you actually physically purchased and you were not leasing. Shows up in kind of the same areas. So you know the presentation you know that we've mentioned so far is not that different, other than having some to break out some lines on the statement of financial position. But again, it's some different tweaks in terminology, lease versus rent, and some right of use assets. So it'll show up there, but again, the numbers kind of would be the same as if you had purchased the asset. Next one. Okay, donated rent. So I alluded to this earlier, and if you receive donated rent or rent, you know, paid as under market rent, the donated rent is not considered in the calculation of that right of use asset or liability. It's recognized as a promise to give and contribution revenue donor restricted at the commencement of the lease. So if you're going to be donated, you know, the rent should have been $20,000 a year and you're paying $5,000, you got $15,000 donated rent. If it's for 3 years, you got $45,000 that you have a promise to give. And so each year after you've made your, you know, done 12 months worth of activity and you've paid your $5,000, 15,000 of the donor restricted would be released from restrictions and moved to the without donor restriction column section in the statement of activities. So you know, in this one you recognize the whole 45,000 as a promise to give and a contribution in the revenue donor restricted, same as you would any other pledge over time, and then you release it as the time progresses. Next one. Okay, disclosures needed. Frankly, this might be some of the harder areas of this whole lease, more involved of this lease standard. As with any new standard comes more footnote disclosures. I don't want to say accountants love footnote disclosures because usually we're kind of at the mercy of the standard settings, but you will have some additional disclosures, general information on nature of the leases, terms, and etc. Okay, maybe kind of what you're leasing, how long it's for, lease payments are going to be so much, if there's any additional payments that are involved with it. Significant assumptions, information on total lease costs. Okay, that's your payments, weighted average remaining lease term, weighted average discount rate, payments to maturity, etc. Now these weighted average disclosures are brand new to everybody. It's and frankly, I haven't worked through one of these yet. Obviously, we will as we get into our lease stuff. But this is brand new from a disclosure standpoint. You know, in the past we've had disclosures on total lease costs, payments that you would have to maturity, but the average remaining lease term and average discount rate. Your discount rate might be the same throughout, so that may not be that big of a deal. And the weighted average remaining lease term, again, your leases, you're going to have a term that you calculate at the beginning, but coming up with weighted averages and over time and what have you, that's going to be a calculation that each lease is going to be separate. It's going to be formula driven, and I'm not even going to attempt to give an example of that because it's going to be different for every lease, and given the lease terms and conditions. So bullet point is what I mentioned there involved calculations for some of these items, and these disclosures are required for both operating and finance leases. So, okay, now we're ready to go ahead. Okay, so last little bit here, lessor consideration. Now, I had mentioned we're going to kind of concentrate on the lessee side, but in some instances, you might have you might be a lessor also for renting out. Let's say you are a not-for-profit and you have some buildings that you rent to low income. Okay, so on you as a lessor, you have to also implement this standard. The good news is the lessor side doesn't have some of the same, there's not a lot of extra compared to the lessee side. But there are three types of leases under the new standard from the lessor perspective. Sales type of lease, it's similar to a sale with recognized profit or loss at the commencement of the lease. Okay, it's like this would be like the capital lease side or the finance lease side on the lessor side. You figure out if you're going to make a profit on this transaction or not, and you recognize the profit right up front. Direct financing lease, very similar to the sales type, but only recognize the loss at commencement. If you had a gain, you'd recognize that over the lease term. Okay, and then you have an operating lease that is not considered a sale, so the lessee keeps the underlying asset on the statement of financial position. Now you say, okay, how do I know what are the criteria for sales type and direct financing? The sales type leases from the lessor side, the criteria are the same as the criteria I had earlier regarding transfer of ownership, 75% of the economic life, 90% of present value of the asset, underlying asset is specialized, and at the end of the lease, the lessor or the lessee is probably going to buy the lease for a token amount of a purchase, the old bargain purchase option. So if you have all those criteria, basically on the lessee side, it's like they're actually purchasing the asset. So on the lessor side, it's like you're actually selling the asset. And then you recognize the profit or loss at lease commencement. Now, let's say it doesn't qualify for sales type. Then you have two criteria for direct financing. The direct financing would be the present value of the sum of lease payments is greater than or equal to the fair value of the asset, generally the cost. And it's probable that you will collect all the payments from the lessee. Okay, so if the fair market value, the present value of all the lease payments is greater than the value of the asset, okay, again, it's like you've sold that asset because you're going to get payments in excess of what the value is. So those first two kind of go together, and if it doesn't qualify under either of those, the default is operating lease. And with the operating lease, it's not a sale or financing of an asset, and you're just going to recognize the rental or lease revenue same as you had in the past as a lessor. And then based on these criteria, if you've got houses or apartments that you're renting to low income as part of your programs that you operate, I believe they're still going to qualify as operating leases, particularly because they're not going to transfer ownership and that type of thing. And the value of the rent is not going to be greater than 90% of the value of the building, or greater than 100%, I'm sorry, of the value of the building. So they're not going to qualify under either the sales type or direct financing lease. So those rents are strictly going to be operating leases. You're going to go on with life as you had in the past. You're going to collect rent, and you still retain the assets, and they show up the same on your financial statements as a fixed asset with depreciation. Now, if showing comparative financials for 2022, you'd have the 2022 column would reflect the new standard, and the 2021 column would be shown under the prior guidance. That is an election that's available for this year of transition, and I would venture to say we are going to do that if you do comparative financial statements. You also have the option to go back and restate 21, but that would really be, I believe, cost prohibitive to do that. It's much easier just implement it in 2022, and it did give you the ability to have a different disclosure in 21 versus 22. So we would be doing the 2022 under the new standard 842 and 2021 under the old standard. I know that was a lot of information, and frankly, everybody's going to be new to this, including our auditors. But it's going to take some time. The best thing that you can do is go through as a not-for-profit, go through your agreements and flag anything you think might qualify as a lease. Again, remembering that the term might not say lease in there. It might have rental or monthly payments or maybe easement or something like that. And if you're not sure of if it's going to be a lease under the standard, put it aside and say, okay, we'll talk with our auditor about it. We'll determine if it qualifies as a lease under 842, and then we will go from there from recording it and doing the proper accounting for it.
Thanks for that presentation, Chuck. So I have a couple of additional questions that came through on some previous sections. If anyone has any other questions that they want us to answer here, it doesn't necessarily have to be on any of the topics that we covered. If there's any other burning questions you have, feel free to submit those here too. I will open it up if somebody would prefer to speak over the webinar too. I'll open that up after I get these couple questions here also. So feel free to save your question for that time too. So Sandy, I'm going to direct this question to you. So how do you allocate a staff member's time spent recruiting program volunteers?
Well, I guess I would look at it as what role is that volunteer going to play within the organization? So for example, if the volunteer is going to be doing program related activities as their volunteer, then I would consider that being a program expense. Any kind of like background checks or anything that you're doing on potential volunteers, I would still put under management in general. But if it's a program related activity, other than, because you're not really hiring anybody, I would consider that to be program. It kind of depends on this. It really is going to depend on the situation and what you're doing, but that'd be kind of the theory I think behind it.
Awesome, thank you, Sandy. So this next question, Matt, I'll have you answer this one. So does Policy Council have the same responsibilities as the board?
Well, I'm not overly familiar with policy councils. I think it's as I understand it, might be a, or it's a group of kind of a parents that make up a council to drive and make the direction of Head Start programming. So I don't know if there's a formal legally mandated fiduciary duty. I mean, I don't know if, I would probably look at that more of as kind of a committee. They may operate as, kind of a mini board, I guess, but with all final approvals going to a full board. So, a full board will drive the direction of the whole organization. And, a policy council to me is kind of more over a program. So I would say, I think, if you're looking at it from an outside perspective, I think you still want to operate like it's your own little board and kind of follow you're making decisions that's in the best interest of the program, which in turn is in the best interest of the organization. Maybe there's some, requirements under, Head Start that require that you have to follow, but I would not say it's in the same capacity as the overall board, just because the overall board is the direction of the whole organization. There's those kind of 3 duties that are followed, but certainly you can kind of look at the policy council as a little mini subcommittee or board, but I don't think it rises to the same level of requirement.
Thank you, Matt. So that is all of the questions that I have had submitted so far. I think everybody has the option to unmute your mic if you'd like to chime in with any other questions. We'll kind of hang on the line here, and if anything else pops up, we're more than happy to answer it. Otherwise, if you have any questions and you want to reach out to any of us directly, feel free to do so. Also, if you have any ideas that you would want us to cover for future topics, or anything else to say about the presentation today, too, feel free to reach out to any of us that were on the call here. Otherwise, a big thank you to all of our presenters today, and a big thank you to all of our attendees, too.